major expenses decrease, we have to see some ROI, and we have to start seeing that now. And we have to remember that AI isn't just about tech stocks. It's literally being integrated into all the things that we invest in. It impacts productivity, operating margins of pretty much every company, software efficiency, logistics, healthcare, and finance. Overall, investing in AI, I always like to tell people that the best way to do so is through a broad ETF. And it doesn't necessarily need to just be AI-centric, and I actually don't recommend it being AI-centric. I like just broad in general, higher technology, but like I said, AI is a tool that a bunch of companies are going to be using, so you don't need to invest just in AI itself to actually get the benefit of this AI thing. This is where broad tech ETFs and diversified growth strategies can benefit without betting on a single winner. I really like VGT for overall technology, AIQ if you really do want to center it all around AI, DTCR is a cool ETF specifically around energy and data centers and what's actually going to be needed because of all this new AI. But then I always love to just come back to the tried and true broad growth ETF like QQQM, SCHG, or VUG. I would pick one of these three over all the rest of them because of the broad growth that it gives, and because long term I believe those are such a good staple for the portfolio overall. Okay, opportunity number 2, and this one's actually going to be the opposite of one of the risks, and this is all about the rate cuts. Like, what if we see actual rate cuts consistently for a period of time, and we actually see by maybe the middle of the year, maybe by the Q3, Q4 of the end of this year, that the rates have gone down substantially. Historically, lower rates help small cap stocks, cyclical sectors, real estate, and just business investment in general. The main thing here is that we don't need anything aggressive. We don't need to see the rates fall super quick in one fell swoop. But if we do see a cut almost every single time that they can cut, then what that starts to produce is clarity. And I've been saying this since the beginning of last year, when the tariffs were first announced and when we were supposed to start seeing the Fed rate get cut and we didn't, and then things got pushed back. The whole problem with the stock market wasn't any one event, it was just uncertainty and not knowing exactly what the heck we were even doing. So with these rate cuts coming and being able to be forecasted and seeing consistency, what that gives is clarity, and then we can invest smart. So again, I know I've said this a couple times, but the end of January at that next Fed meeting is one of the biggest events that we're gonna see for the entire year because it sets the tone. And now opportunity number 3, and this is all about dividend growth and quality, or even value. In volatile or slower growth environment, boring investing usually wins. Companies with strong balance sheets, consistent cash flow, growing dividends tend to outperform on a risk-adjusted basis. And what I'm talking about here is true value. It's true companies with true dividend growth, not just a company that has like a 10% dividend or an ETF that has a 15% dividend. That's not the same thing. Usually those are actually pretty high risk, and they're doing some type of a strategy like covered call or something of that nature. I'm talking about actual solid companies that have been raising their dividends for the past 50 years. Not just having a dividend for 50 years, but raising it every single year. That's the type of company that you want to be invested in right now. And so this is a list called the Dividend Kings. And every single one of these stocks, you can look it up after this, every one of these stocks has a dividend growth every single year for the past 50 years or more. Or even simpler would just be to invest in SCHD, which is one of the best ETFs that I think there is out there for specifically dividend growth. Look at this dividend growth here. And the main thing is that you get to invest in just one thing. You buy this one ETF. It has a bunch of companies that all fit into what I just talked about, with strong balance sheets, consistent cash flow, most importantly, growing dividends. So even if the market stalls out, these companies have shown that even through any bad years, because if they've been growing their dividends for over 20 years, 30, 40, 50 years, that means they've gone through market cycles where the market was down big time, and they still grew their dividend. So SCHD is definitely one of my favorites, but for long-term investors, this can be a powerful anchor in uncertain years. This is why I've been so heavy on making sure you stick with boring ETFs like SCHD or VYM or VTV, and keeping value a big part of the portfolio. 2026 for sure is not going to be easy, but it doesn't need to be scary. The investors that are going to struggle are going to be the ones that chase the headlines, overreact to volatility, and try to time each and every move. The investors who win are going to be the ones that stay invested, they rebalanced early, they diversify, and they focus on long-term compounding. I recommend that you take a little bit of time and watch